Good morning, dear students. I am Ms. Vandana Pai. In today's lecture of the subject Global Finance, we will be studying nature of international finance. Okay, what is international finance all about? Yes, whenever we need to settle international trade or whenever we think about international business or international trade at a time, okay, when the transaction happens between two countries, okay, when the transaction it does happens between two countries at the time, okay, a issue which is common is the currency, okay, because whenever you interact with other countries, okay, their currency and our currency it has a difference, right? Okay, and here the issue which is raised, it is of convertibility. Okay, how to convert a currency into other country's currency. Okay, because many of the time when it comes to international trade, okay, the currency in which the transaction can happen, okay, whether for example if there is a transaction between our country India and a transaction between America, okay, if there is that is USA, okay, if there is a transaction between these two countries, okay, see, when we consider currency of our country, it is rupee, right? Okay, now the currency of USA is dollars, right? Okay, now whenever, okay, a transaction is established between these two countries, okay, what should be the currency in which these two countries will be establishing their transaction? Okay, unknown, right? Because, okay, if you transact in Indian rupees, then the person who is accepting Indian rupees, he is supposed to convert it into dollars, is it? If he wants to utilize that funds, okay, then he is required to convert it in their currency, right? Okay, in the same way, okay, if the transaction happens in US dollars, is it? Now if the person from India, he wants to utilize those funds, then he is required to convert it into Indian rupees. Unless until he converts into Indian rupees, yes, he would not be able to utilize this fund. Okay, so when it comes to international finance, what is international finance? International finance means financing such type of international trade. Okay, there are different institutes, okay, who do support international trade. Okay, so let's see what is the nature of international finance. Okay, means what are the things, what are the essential elements which are included in international finance. Okay, let's see what are this what is the nature of this international finance. See, first one is exchange rate. Okay, what is exchange rate all about? Yes, exchange rate is a rate for which you do exchange the currency. Okay, for example, okay, let's revise the example which we have discussed right now. Okay, if there is a transaction between, yes, if the transaction is between India and America, okay, a trader from India is transacting with a trader or a buyer from America, okay, something he is exporting. Okay, the person from India, the trader from India, he is exporting something to buyer or purchaser from America, if this is the transaction. Okay, now okay, if the thing which this person was exporting to the buyer from America, if the billing or the transaction price it was rupees 1 lakh, okay, the transaction price was rupees 1 lakh. Okay, now when the Indian trader will be communicating the price to American person, okay, the purchaser from America, okay, he is supposed to express those things, okay, this 1 lakh into their currency, that is dollars. So 1 lakh rupees, okay, means how many dollars? Is it this thing is the exchange rate, okay, means what is the rate for which your currency stands for, okay, what is the rate for which your currency stands for, that is called as exchange rate, okay, means how you exchange the currency or what is the price of your currency, okay, this rate itself is called as exchange rate, okay, getting it, okay. Next, it is international financial management, okay, international financial management, what is it? Okay, the transactions which happens at international level, management of the finance related to such type of international trade or international transaction, it is included in international financial management. See, management, it is an essential part, okay, because unless until you manage the funds which are related to international transactions, okay, you will not be able to gain or you will not be able to accomplish the purpose for which you are establishing the international trade or you are entering into the international transaction, okay. So whenever we consider international finance, it is quite important for us to manage the international finance, okay, or to manage the finance which is involved or funds which are involved into international transactions, okay. So whenever it comes to international transaction, yes, you are required to plan it properly, you are required to plan the funds, is it, planning the funds, the way in which you can convert the funds into the currency in which the transaction will happen, okay, or if you are in need of excessive funds, which are the institutes to whom you can approach, okay, all these things they are included in international financial management. It also includes budgeting related to international finance, okay. So then it is balance of payment, okay. What is balance of payment? Balance of payment means balance of payment. What is balance of payment? Balance of payment means, okay, see the transaction which happens, settlement of such type of transaction, is it, whenever the international transaction it does happens, whenever the international transaction it does happens, okay, a statement is prepared, okay. The balance of payment is a statement of all the transactions made between entities in one country and the rest of world over a defined period of time, such as quarter or a year, okay. Means what is balance of payment? Balance of payment is just a statement, okay. Balance of payment is just a statement through which, okay, what is done, through which yes, the transactions made between the entities in one country and the rest of world, okay, they are noted, okay. Balance of payment includes both current account and capital account, okay. The current account of this balance of payment, it does includes a nation's net trade in goods and services, its net earning on cross-border investments, and its net transfer payments, okay. The capital account consists of a nation's transaction in financial instruments and central bank reserves, okay. The sum of all transactions recorded in the balance of payment should be zero. However, exchange rate fluctuations and differences in accounting practices may hinder this in practice, Okay, the balance of payment, also known as balance of international payments, summarizes all the transactions that a country's individual companies and government bodies complete with individuals, companies and government bodies outside the country. Okay, these transactions, they might result of imports and exports of goods, services, capital, as well as transfer payments such as foreign aid and remittances. A country's balance of payment and its net international investment position together constitutes its international accounts. Okay, the balance of payment divides transaction in two accounts. The first account is current account and the second account is capital account. Okay, sometimes the capital account is called the financial account with a separate, usually very small. Okay, capital account listed is separately. Okay, the current account includes transaction in goods, services, investment, income and current transfers. Okay, the capital account, broadly defined, includes transactions in financial instruments and central bank reserves. Narrowly defined, it includes only transactions in financial instruments. The current account is included in calculations of national output while the capital account is not. The sum of all transactions recorded in the balance of payment must be zero as long as the capital account is defined broadly. Okay, the reason is that every credit appearing in the current account has a corresponding debit in the capital account and vice versa. If a country exports an item, if effectively imports foreign capital when that item is paid for. Okay, if a country cannot fund its import through export of the capital, it must be so by running down its reserves. Okay, this situation is often referred to as balance of payment deficit. Using the narrow definition of the capital account that includes central bank reserves, in reality, however, the broadly defined balance of payment must add up to zero. In practice, statistical discrepancies arise due to difficulty of accurately counting every transaction between an economy and the rest of the world. Okay, including discrepancy caused by foreign currency translations. Okay, so this is all about balance of payment. Then it comes to debt securities. Debt securities, what is meant? Okay, securities means, okay, debentures. Okay, if your transaction is secured by debentures or such type of debts, okay, then it is also included in means at international level. If you do such type of transaction, then it will be included in debt securities. Okay, then IFRS. Okay, IFRS, International Financial Reporting Standard. Okay, International Financial Reporting Standards set common rules so that financial statements can be consistent, transparent and comparable around the world. Okay, IFRS are issued by the International Accounting Standard Boards. They specify how companies must maintain and report their accounts, defining types of transactions and other events with financial impact. IFRS were established to create a common accounting language so that businesses and their financial statements can be consistent and reliable from company to company and country to country. Then, International financial reporting standards were established to bring consistency to accounting standards and practices regardless of the company or the country. They are issued by the Accounting Standard Board, that is ASB, okay, and address record keeping, account reporting and other aspects of financial reporting. IFRS benefit companies and individuals alike in fostering greater corporate transparency. The downside of IFRS are that they are not universal, with the United States using GAAP accounting and a number of other countries using other methods. Okay, so IFRS are designed to bring consistency to accounting language practices and statements, and to help businesses and investors make educated financial analysis and decisions. Okay, the IFRS Foundation sets the standards to bring transparency, accountability, and efficiency to financial markets around the world. Okay, fostering the trust, growth, and long-term financial stability in the global economy. Companies benefit from the IFRS because investors are more likely to put money into a company. Balance of payment. So, IFRS, they issue standards for financial transactions. Okay, as per the requirement of IFRS, we are required to maintain accounting activities. Okay, then it is International Monetary System. International Monetary System is a set of internationally agreed rules, conventions, and supporting institutions that facilitate international trade, cross border investment, and generally the reallocation of capital between nation states. Okay, it should provide means of payment acceptable to buyers and sellers of different nationalities, including deferred payment. To operate successfully, it needs to inspire confidence, to provide sufficient liquidity for fluctuating levels of trade, and to provide means by which global imbalances can be corrected. Okay, the system can grow organically as the collective result of numerous individual agreements between international economic factors spread over several decades. Alternatively, it can arise from a single architectural vision, as happened at Bretton Woods in 1944. So, whenever we consider International Monetary System, what is it? Yes, it is a set of internationally agreed rules, okay, convention and supporting institutes that, yes, surely support the international trade. Okay, then FDI, that is the foreign direct investment. What is foreign direct investment? Yes, through this you do entertain foreign investment into your country's companies. Okay, why? Okay, any country can do investment in any company. Why this thing is done? Yes, the only motive is that so that your company can be financially sound. Okay, why this thing is done? Yes, after globalization, foreign direct investment has gained is important. Okay, important because you can also use their practices, best practices into your country. Okay, so that it will be easier for you to manage the international transactions. Okay, to manage the international settle the international transactions. Okay, so with this we do conclude today's lecture. Thank you.